You've been saving for retirement for 30 years. Your account says $1.2 million. But here's what nobody told you. A huge chunk of that money doesn't belong to you. It belongs to the IRS. And depending on one decision you probably made in about 5 minutes during HR onboarding, that bill could be anywhere from $80,000 to over $400,000. Let's fix that. Here's what we're covering today. First, why the account with a bigger balance isn't always the one with more money. Second, the exact scenario where the wrong choice cost someone $400,000 in taxes they didn't see coming. And third, the 3-step order that most financial planners actually recommend, but almost nobody follows. No fluff, let's get into it. Here's something your HR department never said out loud. Every dollar sitting in a traditional 401k or traditional IRA has a silent business partner. He doesn't show up during the accumulation years. He doesn't announce himself when your balance hits 100K or 500K. He just waits. His name is the IRS, and he owns somewhere between 22% and 37% of everything in that account. Here's the story. 2 people, call them Dana and Marcus, both 30 years old, both earning $75,000 a year, both saving $500 a month for retirement. Same discipline, same starting line. The only difference, Dana puts her $500 into a traditional 401k. Marcus puts his $500 into a Roth IRA. For the first decade, Dana looks like the clear winner. Her contributions are pre-tax, which means every dollar she puts in reduces her taxable income right now. At a 22% bracket, her $500 contribution only costs her about $390 out of pocket after the tax savings. Marcus is putting in the full $500 after taxes every single month. No discount, no break today. By year 10, Dana's balance is bigger on paper. But here's the thing nobody talks about at the barbecue. Dana's $1.2 million at retirement isn't $1.2 million. Every dollar she withdraws gets taxed as ordinary income, the same rate as a paycheck. Marcus's account? Every dollar he pulls out is completely tax-free. He settled that bill 30 years ago when his bracket was low. The balance comparison is a lie. The only number that matters is what you actually get to keep. Now let's run the real math, because this is where it gets uncomfortable. Dana retires at 65 with $1.3 million in her traditional 401k. She plans to withdraw $70,000 a year to live comfortably. The IRS treats that $70,000 as ordinary income, same as a salary. After the standard deduction, she owes roughly $8,000 in federal taxes every single year of her retirement. Over a 25-year retirement, that's $200,000 in federal taxes alone, just on withdrawals. But it doesn't stop there. At age 73, the IRS forces her to start taking required minimum distributions, RMDs. She has to withdraw a specific dollar amount every year, whether she needs the money or not. If her account has grown to $1.5 million by then, her first forced withdrawal is roughly $57,000 on top of whatever else she's already pulling. That pushes her into a higher tax bracket, and it makes up to 85% of her Social Security benefits taxable. Money she paid into her entire career, now getting taxed again. Marcus? He has 0 RMDs. His Roth IRA can sit completely untouched for as long as he lives. He controls exactly when he pulls money out and exactly how much taxable income he has in any given year. That control alone is worth a fortune. By the time you add up federal taxes on withdrawals, the bracket creep from RMDs, the extra Social Security taxation, and potential Medicare premium surcharges from higher income, a realistic gap between the traditional account and the Roth account over a full retirement is $400,000. That's not a scare tactic. That's the math. Now, before you close your 401k and open a Roth tomorrow, stop, because I'd be giving you half the picture if I only showed you the Roth's advantages. The single most powerful argument for the traditional 401k isn't the tax break. It's the employer match. If your employer matches 50% or 100% of your contributions up to a certain percentage of your salary, that's a guaranteed return before the market does a single thing. No investment strategy on earth reliably guarantees a 50% return in year 1. Walking away from a full employer match to chase a Roth IRA is one of the most expensive mistakes a retirement saver can make. There's also the contribution limit. In 2025, you can contribute up to $23,500 to a 401k. The Roth IRA caps you at $7,000. If you're in your peak earning years and you're in a 32% or 37% bracket right now, deferring that income until retirement, when your bracket might genuinely be lower, is a smart, legitimate strategy. The traditional account wins in that scenario. The math actually works in your favor when you defer at a high rate and pay at a lower one. And if you earn above $161,000 as a single filer, you can't even contribute directly to a Roth IRA. The 401k has no income limit. For high earners, it's sometimes the only game in town. The traditional account isn't the villain here. The mistake is picking one without knowing which situation you're actually in. Every time someone contributes to a traditional 401k, they're making a bet. They're betting that their tax rate in retirement will be lower than their tax rate today. Most people make that bet without realizing they're making it. Here's the problem. Nobody knows what tax rates will look like in 2045 or 2055. In the 1950s, the top federal rate was over 90%. In 1980, it was 70%. Today, it's 37%. The U.S. national debt is currently over $36 trillion and climbing. Rates have been historically low for the last decade. The idea that they'll stay this low forever is, honestly, not a safe assumption. When you contribute to a Roth IRA, you're locking in today's rate. Whatever you pay now is the final bill. There are no future unknowns. The IRS got their cut. Everything from that point forward, every dollar of growth, every withdrawal in retirement, is yours, completely tax-free, regardless of what Congress decides to do with tax rates in 2040. For most people in their 20s and 30s, earning $40,000, $60,000, $80,000 a year, that lock-in is one of the best financial decisions they can make. You're in a lower bracket now than you'll ever be in your peak earning years. Pay the tax today. Let the next 30 or 40 years of compound growth belong entirely to you. So what should you actually do? Because the answer isn't always Roth, and it isn't always 401k. The answer is both, in the right order. And this is the sequence most certified financial planners will give you if you ask them where your money should go. Step 1. Contribute to your 401k up to the full employer match. If your employer match is 4%, you put in 4%. That is a guaranteed 100% return on that portion of your money on day one. It's the single best deal in personal finance, and it's not close. Do not skip this step for any reason. Step 2. Max out your Roth IRA. Put in the full $7,000 for the year, or $8,000 if you're 50 or older. You've already grabbed the free money from Step 1. Now lock in tax-free growth for the next 30 years. Every dollar you put in here is one the IRS can never touch again. Step 3. If you still have money left after maxing the Roth, go back to your 401k and increase your contributions toward the annual limit. The pre-tax deduction still has real value, and the higher contribution ceiling gives you more room to shelter income from taxes right now. Someone who follows this sequence, capturing the full employer match, then maxing the Roth, then continuing in the 401k, will almost always end up with more after-tax wealth at retirement than someone who picked just one account and went all in. It's not exciting. It doesn't make a viral headline. But the math doesn't care about exciting. Here's the bottom line. The decision between a traditional account and a Roth isn't about which one has a bigger balance. It's about which one gives you more money after the IRS takes their cut. And the gap between getting that decision right and getting it wrong over a 30 to 40-year retirement can easily be $400,000 or more. One question decides everything. Do you want to pay the IRS now, when you know the rate, or later, when you don't? If this one helped you, hit subscribe. We drop this kind of content every week. See you in the next one.